Good morning, everyone. If you can hear me, please type in the chat box. My name is Josip Kosik, and this is a live session, Options with Options. Um, my email address is down here in case you need to get in touch with me. I would greatly appreciate if you send me an email with any questions. And we are going to show you disclaimers. They're very important because what we're going to do today is we are going to go over what I like to call good, bad, and ugly of a long call. So this example that I'm going to give is strictly for educational purposes only. Good morning, Mark. Good morning, Joe. Good morning, Jeff. It's great to see you. Um, I got some good feedback about the lesson that I did on Friday, which involved changing the spread into another spread if something goes wrong. However, for this lesson, I decided to actually focus on a good, bad, and ugly of a long call. So again, I'm disclaiming this is for educational purposes only. I want to dig deeper into the detail of how you can place the long call and basically evolve it into something else. And that's why I don't suggest that you take any of this trade unless it's a paper trade. So little review of the market and what the market is doing. So market has surprised everybody this morning by simply gapping up. And this is an interesting situation because it's gapping up and it's holding. But if you run this down from the left to the right, we have this 9-day exponential moving average that pretty much shows us the trend. And as of now, we are still in a downtrend. One day does not make the trend. So this gap up can easily get filled in the near future. Same thing with these other gaps that we have right above us. They can get filled. And the situation is that we are currently oversold, and there's a high chance when we are oversold that there needs to be some kind of bounce. So this is exactly what is taking place. So what I'm going to do right now, I'm going to go on the option chain. I'm going to select at the money, and I'm going to select, actually it's similar to what I did on the last session, the current expiry. Why do I select that? Because then I don't need to focus on too many other things beside what I really want to focus on, and that is the intricacy of the long call. So again, the price of the S&P is dancing around 376. Therefore, the 375 call would be the call that currently has intrinsic value of about dollar and something, right? So what are we going to do here when we single click on this and we consider a risk graph for that particular trade for a long call? So we have here June 21st, 375 call, and it gives us all this information about the bid, ask, volume, open interest, but more importantly, delta is what I like to focus on today. Delta is what I want to focus on today. So I'm going to entertain this with the explanation what is going to happen if we move $1 higher, and how this thing is going to get added up. And I'm going to then talk about if something goes wrong and we move down, and how is that going to work out. So again, just this one area that I'm copying, it involves a long call with the information of the delta, gamma, and at this point I'm not going to focus on theta because I simply feel that would be perhaps a little bit too much. So what I'm doing right now here, this is the agenda for today that I decided to call good, bad, and ugly. And I want to just walk you through the fact that if we went ahead and we bought the call that is currently at the money, and that's the 375 call. The 375 call, while the SPY is at, so if the SPY is currently sitting, and I'm going to just type in the number, and I know this thing is dancing, it's not completely accurate, because as I'm typing this, like this thing can move either up or down. So if the S&P is at 3780 at this very second, and again, this is going to change as I'm typing. Then this at-the-money 375 call has the intrinsic value or at-the-moneyness of the 80 cents. Now, would they price this at 80 cents? Well, in a perfect universe, that would be 80 cents. In fact, today, that would be 80 cents at the expiry, like 1 minute or something like that. But what is really happening here that they have jacked up the asking price to basically $1.80. So when you're looking at this, due to the volatility and all these other components, we have this time value, even on the last day of the expiration, that is worth $1, or that is also called extrinsic value. So if that sounds good, like I would really appreciate it that you type in, I got it, I know what you're talking about. So why did I pick out the money? Because out the money is the one that has the most of activity. Look at this morning activity is already at 77K, right? Of course, the open interest was way below that. So the question then becomes, what are the institutions doing? Because we know this contract is ending today. And if this contract is ending today, there's no way that this 77,000 can be closing this 8,000. That's mean they're opening this position, and by the end of the day, something's going to happen. So now somebody might make an argument, well, maybe they're selling the call because they're anticipating a pullback. Now, I understand that is one of the possibility, but I don't necessarily agree that that is the main possibility that is out there. And the reason why I'm saying that, I'm going to just quickly bring the FinViz because it's a quick way for us to look at all three markets. So Dow is up 600, NASDAQ is up over 3%, which is obviously strongest of them all. And then you have a S&P that hasn't had a red 10-minute bar ever since it opened. So why would I now fight the trend, teach you anything else when this is one of those rare days after so many days of being beaten down that you have a sea of green, and it makes sense to actually teach you this. However, going into the lunch hour, in case something goes wrong, I have an at the money call that I can turn into anything else if the time is called. So we have a session here that is going to have 6 of these 10-minute bars during our session, because each of these bars is at 10 minutes. And I'm hoping that there's going to be something rather than just a chop, so I can evolve this trade that, as I said to you, have a 3 possibility. It has a possibility of being bullish, which is obviously now, due to the fact that we have opened this as a bullish. We can turn it into neutral, and we can, of course, turn it into bearish. So one more time. Bullish is simply buy, right? So we went ahead and we bought this. We can turn it into neutral, but I don't want to do this right now, because why would I turn it to neutral if this thing is going up, right? Or I can turn it into bearish. And I'm going to walk you through all of these things, as I explain these things. So let's now do the first logical explanation. My bullishness is only whatever the delta is. So when you look at this particular case, my delta is, and I'm going to round this up to basically 60 cents. So if my delta is a 60 cents and a SPY moves from the current price of the 357.80, and I'm going to use exactly $1 high, right? So now it's a $1 higher at 6. What is going to be my value of the original ask that I paid? Well, you would still have an ask of the 180 that you paid, but you would need to add the delta. And that delta is 60. So that delta is 60. So it's simple like that. Reason why I'm breaking this thing down, because I want to share with you like my very, very first trade that I ever did. And I'm going to actually start typing this even right above here, so you would kind of understand the logic, how it was when I started to trade, and what is it that I was looking at when I was placing the trade. So I had a target, I had an entry, and I had a stop, right? And at that particular time, the stock that I bought was trading for $32. I decided to put the stop at 30. And that is basically where the demand zone was, and if we were about to go down, this is where I would get taken out, right? So now I'm going to talk about the option universe here, just for you to kind of understand the whole logic of what was happening with the options rather than what was happening with the price. So I'm talking about now premium, right? So when I'm looking right now of the premium, my delta, because this was at the money when I bought, was 50. If we go down $2, how much am I losing out of my contract? I'm losing exactly $1 of my contract. That's it. And I hope that's clear, because it doesn't matter the stock went down $2 because you haven't traded the stocks. You have traded the premium, and I'll give you information where that premium was in a moment. But I just want you to be aware of it, that everything is based off the delta. So what really happened here is that I paid for what was then, had I bought the shares, $3,200. I remember paying exactly in a premium of the at the money $30 call, right? Which was then $2 in the money. And I hope that's actually clear, because if the stock is sitting at 32 and I'm buying $30 call, that is then $2 at the money. And I'm going to ask you if you can predict and type in the chat box, what do you think they charge me for that at the money $30 call when the price of the physical and underlying is at 32? So please start typing anything greater than 2, because 2 would be that they didn't charge anything for extrinsic. And I'm going to just take a sip of water. I want you guys to get engaged. So I expect Mark, Joe, Jeff, to type in any number in, so you can kind of try to get engaged with this and recognize what it really I'm trying to teach about this SPY call based on what is happening here with everything. I'll give you a hint. I paid $3.50. Did they rip me off? Well, same as here. Take a look. 80 cents is the true value, because we are currently 375.80. My 375 call on the day of the expiry has an at the moneyness of the 80 cents. Then why do they charge me for a time value $1? Because they could. They would call this anything. They would call this extrinsic, Vega, and all this type of thing. So what means that when you buy at the money, you actually buy more of the extrinsic than what you're buying intrinsic. In my case, in that particular example, my time value was actually $1.50, but my at the moneyness was actually $2. So I hope you kind of recognize in that particular case, this is what it happened. So I was willing to lose money on it if we drop down $1. So if we drop down the $1, I wouldn't lose all 350. At that point, I would be getting out if that was the same day at the 250. Well, how do you calculate that? Well, think about it. If the stock did not go up, right? That's mean the long call didn't go up, and I got stopped out with the $2 loss because the price has gone from the 32 down to 30. So that's mean I only lost the delta, 50 cents for the first and 50 cents for the next. Just like in this case, when we are going up, it doesn't matter that SPY, the ETF that tracks the S&P 500, has rallied $1. We actually only we only gained what? 60. So I remember at that time, I was a new trader, and I have put my target at 5. And what do I mean by at 5? $5 even. $5 even. Now, just by looking at this, could you figure out what was really my target? Well, at the time, I looked at the chart, and demand zone or the support was at 30, and the previous resistance or supply zone was at 35. So when you have the price action go to 35, what has really happened when the stock has moved from the 32 to 33? you only made a 50 cents. And when it went up from a 33 to 34, then you made $1. And when it went from a 34 to 35, then you made another $1. Hence, there's a reason why I actually have captured this word gamma. Because what is interesting on this first move, ladies and gentlemen, I'm making whatever the delta is. But if the SPY now goes another $1 higher, okay, another $1 higher. So just stay with me here and try not to lose me here, because I'm going to really walk you slowly through it and just explain how this thing works, right? So my new value over here of the new premium is $2.40. So now I need to start calculating what is really happening here when we are at $2.40. I'm still adding the delta of 60. So you would say, well, that's then $3. That's then wonderful. Yeah, but there's also a component called gamma. Now, gamma kicks in on a second step, not on the first step. So that's mean on a second step, additional 10 cents is being added. So my really new premium at that point is $3.10. And I'll stop and repeat this one more time. So for the first dollar up, that's mean when the SPY goes from 375.80 to 376.80, had you traded the stock or an ETF, you would have made 100 cents. But in this case, because I was trading the delta, and you can see right here, delta, and I kind of rounded up, don't worry about this, like that. It's really 59 cents. I just want to keep the thing simple. So I kind of said that delta is 60. So right there. So this is a delta of 60. All that I made on this move up is 60. Now, the reason why I'm teaching you this, because if I later on turn this into any other spread, you would be having a lag from which you would need to then subtract the difference. So you really, the best thing for you to understand how the long call works is that you isolate it and you just work on it in isolation. You work on it in isolation. So let's now proceed with this and move on. What if the price moves another $1 higher? So if the price moves another $1 higher, my starting point is still $3.10. Now be aware of it that this $3.10 is not necessarily what I made, because out of this $3.10, what was my cost? My cost was $1.80. So then, like, what are you making right now? Well, think about it. This 60 cents plus 10 cents creates a new delta. So now I have a new delta. And I like to say D is D. That means delta is dynamic. It's not fixed. It was fixed at that point in time when I got in. But since then, it has changed to 70 cents. So I think, okay, so now you're making 310 plus 70 cents, 380. Yes, but you also have a gamma. So now I'm going to ask a question. I'm going to sip of water, and feel free to type in the answer. Do you think the gamma is increasing? Is the gamma staying fixed, or is the gamma slightly decreasing? Hint, hint, hint. Think about this. Think about this. So I'm going to just minimize this here, and I'm going to actually just move this so you can focus right here on a gamma rubric here. What is happening here? 10 cents, whether it goes out of the money or it goes in the money, you see how it's dropping. Over here is 8 cents, over here is 5 cents. So then the highest one is always near the moneyness. So that's mean that on the next step, my gamma has decreased to probably 8 cents. So then what did I really make over here? $3.88. This is the way how this thing works when we are moving to the upside. But what about if something really, really bad happens? And as of now, I'm checking the market because I'm teaching here with one eye, and with other eye, I'm kind of watching the market. And I just want you to see here that market is doing exactly what I was fearing. It's doing nothing right now because it's a lunchtime and it's just pausing. So I wouldn't be surprised that we just chop around for the rest of the session, Now on the Dow, there was a slight little pullback, but the buyers came in and started buying it. Um, let me just do this quickly, so I have something solid that I can deal with. So I'm going to just go here quickly in a SPY. And okay, you see it's now down by whatever, the 10 cents. So I'm going to just go ahead and buy one contract of that one. So I'm going to buy single 183. So of course the price is live and it's dancing. Confirm and send. Got rejected. I don't know why would that be the case. Let's just go over here. It's a paper trading account. I really shouldn't be worried about that. Okay, so 182. So that's what I'm playing. Plus the 65 cents commission. So that's $182 and 65 cents out of my account. Bought one contract. And this is now open position for me. Okay, so now let's talk about the next scenario. Okay, what if I want to turn this into, see, I shouldn't be turning it anything into right now. If this thing is going up, it's beautiful. But what you need to realize, if the expiration comes in right now, and let's say now it's 4 o'clock Eastern and a bell rings, what is the true value when a SPY is true value of the 375 call at expiration? What is it? Well, at that point, it would be the difference of the two. So it doesn't matter over here that it says you're $3.88, because the true value of that point is $3.80. So what do you think is going to go out of that long call as the time passes? Extrinsic value or the time value? So let me now just go over the basics of the long call, and I really need to emphasize this: good, bad, and ugly, right? So I emphasize the good. D stands for dynamic. Delta is not fixed at 60 cents. As the market goes up, gamma gets added to it. But at one point, the gamma gets maxed out and gamma start going down, down, and down. So if we go now to the next one, that we have moved from 378.80 to 379.90, my new delta would be then 78, but my gamma would then drop probably to 6 cents. So let me just repeat this one more time, what I'm talking about. So if I have now price go up another dollar, my 388 means that I have a newest delta of at 78 cents. So that means I would need to be adding this. So whatever that number is, I would then add also gamma to it, and that gamma is going to be probably about the 6 cents. And then for the next one is going to go down at 4, and the next down is why would that be the case? Because at one point my delta becomes 1, and if my delta is 1, the gamma needs to be nada, nothing. You cannot make on an option more than what the physical 100 cents movement is. You can be tracking it very closely, but you can't make it more than that. And let me now show this on the chart so you will understand it. So when I go over here and I ask you just to focus on the deltas here, this is the deep in the money delta that has an 85. So let me just put a square around it so you can actually see it. So here's a square around that particular delta. And that particular delta concerns this particular call that is 372. So obviously, if we are now dancing around the 376, 372, that's a $4. There's a reason why this is priced at $4. Because the $4 is intrinsic value, but they play with this extrinsic value and they jacking it on the bid by 30 cents and on ask by 40 cents. But that's not what I wanted to actually point out to you. What I wanted to point out to you that this delta on a call side is going to be delta of the put side here on 15. I would need to move this so you would actually see it, that on this side the delta would be then only 15, because when you have a 15 plus this 85 5, that's 1. It works the same way on opposite end. 379 call is out of the money. Why would be out of the money? Because we're right now sitting at 376. That's the $3 out of money. So everything is flipped. So on this side, put has a delta of 80 something, while over here call has a delta of only the difference, because once when you add these two things, it's still 1. Okay, I hope that's clear. So I don't want to beat the dead horse, because this is really just a good, bad, and ugly of a long call, right? So just be aware of it. This is what I was trying to um, teach, to kind of emphasize, why is this the way it is. So one more time, when do you do the long call? You do the long call when you feel that you are getting the privilege from the premium moving up, and you don't need to pony up as much cash as you are ponying up when you are buying the physical underlying. So in my example, my very first trade was $30 stock, right? Stock at the time was trading for $32. I did have in account 3,200 to buy the physical underlying, and if I bought the physical underlying for 3,200, I would exit at 3,500. But that would be big outlay of the capital. Instead, what happened over here? I bought it for 350 and I exited for 5. So you might say, well, you got cheated because you did not make the $300 move. Yeah, but when I got in, my delta was at the money, and I was only able to get whatever that delta is. Yeah, that delta did get increased higher and higher and higher, but once when I exited, that was 41% rate of return on that thing. So I'm gonna visit one more time FinViz and see if there's a little pullback. Yes, this is nicely shaping up. So we're having a slight little pullback. This is maybe just a breather. Maybe we're gonna go higher up. But what about if I make assumption this thing has really hit the serious resistance? It has hit the floor. It can't go any higher. Now something needs to happen. Well, there's a few things that you can do, and I really mean few things, because can you turn your bullish bet into somewhat neutral? Yeah, you can turn it into a bull call. Now, why would I call this neutral? Well, this is really neutral to bullish, because the real neutral would be if I turn it into an iron condor. That is not lesson for June 21st of the 2022. That can be lesson for another time, but not right now. So really the most bullish one is one when you have a unrestricted delta. And what do I mean by unrestricted delta? This delta, as I have pointed out to you, has grown in this particular case to 70. And then it has grown to even higher delta of the what? Of 78. If this particular product, which sometimes can move easily $10 in a day, could this become even higher? Sure. Okay, let's just calculate. Okay, so if I have now SPY that is sitting, I'm sorry, this was supposed to read 79. My bad. Okay, 77, 78, 79. Okay, so let's say this example, if I put it right here, and I'm going to just focus on a delta, becomes a 380.80, right? What would be my new delta? It would be 78 cents plus 6, so that would be 84. How about for another dollar higher? If we are now sitting at 381, well, I would need to add then new gamma, and that gamma probably has dropped to about, I don't know, let's say 4 cents. So then new delta over here is going to be almost 90. It's going to be 88. And then the next step is going to be 90, and then it goes till it actually virtually maxes out at a certain level. And you can see all this if you would just take the time to look at gamma. So you would then need to know what you need to focus on. So right now we're showing the 3 strike prices below at the moneyness and above at the moneyness. But if I change this from the 3 strike prices to, let's say, maybe 7, I know it's going to be a lot of information right here, but you see how gamma actually almost like maxes out here at about 2, and then it remains that way. So up here was a 3, up here was 4, up here was 5, and so on and so forth. You're kind of getting this, what I'm heading with this. So just be aware of it, that the bullish trade is the one that has unrestricted delta. And I am not like a lot of traders out there who say, just get in with the 92 cents delta. Okay, if I get in with the 92 cents delta on a dollar higher, I made a 92. But stop and think about it. What about if you have what we are having right now here, a pullback of the whole dollar, and you have a 92 cents delta? And I'm going to take a moment and ask you a question. Your delta is 92 and it's not going in your direction. How much money are you losing? D is D. D stands for dynamic delta. You got it. 92 cents. Thank you. Ahmed, good to see you. 92 cents. Why? Because you picked the high delta. So aren't you better off picking what I did the very first time when I started trading that in early 2000, delta of the 50? Because even if you went down from a $32 to 31, and let me insert this. Let me insert this in this column, so you can kind of follow it. So if the stock dropped down to 31, what did I lose in that point? I lost the delta of 50. But that 50 on the top of another dollar, it becomes a total loss of the one, versus somebody who has gone in, booyah, I'm going to buy the 92 cents delta, and then the market pulls back $1. And it's really irrelevant whether the price is at the $32 or it's at the 379, because the delta is a delta. Delta is a cylinder of your engine. So whether you have like a car with the 6 cylinders and one cylinder is broken, or you have a car with the 12 cylinder, or a truck with the 12 cylinders and one cylinder broken. Once when the one cylinder is broken, it's broken. It's simple as that. So because we're pulling down now, right, we're taking a breather from a move up. And as I said, I don't know if it's going to be another leg up, because why would I go short right now if you're not taking out the low? I can really turn this into a bearish bet if this condition happens. This low is taken out, and simultaneously Nasdaq low is taken out, and simultaneously the Dow is taken out. Then look out below. We're probably coming down to what? To fill the gap, right? So what I want to now point out to you, I'm going to turn this position that I have open in paper trading account that is now losing me money, because obviously it's about 50 cents drop. Did you see that? It's about 50 cents drop. So 50 cents drop on my delta that was 60. That's mean I lost about 30 cents, right? Did you follow that? Let me repeat this one more time. This thing measures it for a $1 drop. But what about if you don't drop the $1? What about if you drop only? So I'm going to type it right here. Drop off only, what is it now? 40 cents or 50 cents. Drop of 50 cents equals new SPY sitting at the 375, let's say 30, right? Because that's a 50 cents. My delta, which is originally 60, means loss of 30 cents. And be aware of it. I'm not watching any of these other components such as theta, vega, and rho. In this lesson, on June 21st of 2022, I don't want to focus on that. Or on a future lesson in July, whatever, we have an next session, I can focus on that. What I want to right now point out to you that this is not going the way I want it. Because if I have paid $1.80 and currently this thing is ticking at $1.50, okay, this thing is dancing, right? As you can see, I lost 30 cents, which is exactly what the delta is. Could I do something on it? Could I recoup some of it? Well, first, if I know that I lost only 30 cents, hint, 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 could I sell the 378? And this is exactly what I want to teach. So what I want to teach right now is how do I turn this particular situation while the market is pulling down into something else. So you go edit spread, you go simply into edit spread, and we're gonna one more time emphasize, I want to regain that 30 cents, and I can regain that 30 cents by doing the 378. And still I'm not changing the bias. Are you with me? My bias is still the same. So 378. This is actually leg that I shouldn't change. I should change the one on the top to 378, to 378, 378 call, right? So now when I click this, I'm going to calculate this, and I'm going to say you're going to bring in some money and your total cost is going to be less. Well, having said that, why don't I just simply go ahead and sell this? And now I'm bringing in 31 cents by selling this. Oh, I just lost you. Well, no, you really didn't lose me. You actually understand that the most that I can make here is $3, 75 to 78. So let me now slow down here, explain this, and then look at how advanced the top tradeactive option planner is, because it can do all of these things for us and we don't need to do anything. So this one is nothing else but the long, I'm sorry, I have a fat finger here, 375 call at $1.80. Okay, this one actually involves selling to open 378 call that is currently out of the money at the credit of, I believe I got filled in for 31 cents. So now when you're looking at this, and I'm going to just copy this, so I have this over here as well. Okay, so what's my total enchilada? Well, this is why I'm saying this thing is so powerful. I can just single right click here, go to the risk graph, and everything is calculated here for me. Okay, so the most that I can make on it is an additional $139. Let's take a picture of that. Just 1 second, I'm going to take a picture of this. Print screen. You have to change right now to those pennies, but anyway. Okay, so I'm doing it right here. Explanation of it. So the difference of the two, so when you subtract this from this, then you get the 161. If we close anywhere above, so let's say right now is the expiry. So at 4 p.m. Eastern Standard Time, SPY is sitting at the 378. Just cut this and move it down here so it will be more clear. What am I talking about? So if the SPY is at 378, what do we have here as a situation? Well, what we have as a situation is that my 375 call is in the money by $3, and sold 378 call has not even 1 penny of the value. You recognize this would need to be a 378 and a penny for this 378 out of the money call to have some value, but as of now it doesn't have any value at all. Hence, that's why this looks this way. So over here is a 0, and over here is a higher number. So when you're looking at the higher numbers, currently we are falling down. We are at the 37.20. But if we start going up and up and up, once when we hit this area right here at 378, we maxed out. We cannot make anything more. And now when I show you the FinViz, you would see what goes up most of the time must come down. Now, again, this is still not bearish. Please look at the overall picture. Yeah, we have some pockets in communication that are turning red. We have some pockets in financials. It's kind of dotted, I mean, this could get a lot worse. Trust me, this could get a lot worse. But again, what I want to point out to you, look at the size of this 10-minute bar, how violent that is. At any given time, we can get one of those bars that would negate. These are the 10-minute bar, 10-minute bar, 10-minute bar. Right now it's 8:40, so we have four of these 10-minute bars. We can get one green bar that completely wipe this thing out. So this is what I'm talking about. This is what we currently have, and the market is pulling back. So now when you're looking at this, you're scratching your head and saying to yourself, well, maybe you also need to explain the bearish band. So the neutral would be that I have turned this into the bull call spread. But if my 375 loses a value, which is very, very possible, because look, right now we're only 26 cents in the money. So if the bell rings right now, so I'm gonna just create this scenario, and I'm gonna type it in 375, whatever that number was, like 25. That's the expiry. That's the expiry. I mean, that's the today's 4 o'clock Eastern, and we're not where we should be in terms of my desire. My desire originally was that SPY should be up here at 378 for that bull call spread to really work out. But let's say the reality kicks in and we close at 375.25. Out of this $1.80 and 31, I only have a inner moneyness of the 25 cents. Hint, hint, hint. That's why I call this lesson good, bad, and what? Ugly. Ugly. Now, here's a final question that I have for you in this last 18 minutes that I have. Could I turn this into a bear call spread? Answer is yes, but I think that is a really, at this point in time, a wrong bet. And the reason why I'm saying it's a wrong bet, because we need to then sell to open lower strike price, and that will need to be either 37, 374.50, or even worse, 374. Now, I don't know if we have a 50 cents increments. We can double check this in a moment here. No, on this particular cycle, we don't. Most of the time we do. Actually, we don't. You know what? Then I only have a choice to do the 374. But what is the problem with that? Currently, ladies and gentlemen, we are at 375.25. That means it would need to drop another $1.25. And be aware of it. Once when you switch this into bear call, there's no way fixing it. There's really no way fixing it. You have made your bias to be bearish on a day that is bullish. So you better be right, because you are anticipating in that case price to go way, way, way lower. So let me refresh this page. Yeah, and it doesn't seem to me that it's going lower. You see, this is exactly what I was saying to you, that you might have this minor pullback and then a big green bar to rip to the upside. So I'm going to wait for you to type in the chat box how many of you want me to actually to make this into bear call spread on a today's expiry when you only have like not even 6 hours left. Take a moment to type it in. Ahmed, Jeff, Joe, Mark. If you want me to do it, I can do it. And that's why I was disclaiming that this is strictly for what? Educational purposes only. Strictly for educational purposes only. Because I'm going to revisit the chart, because every time when you're not sure, it's very important that you revisit the chart and you ask yourself, what am I seeing on the chart? Well, I do see the possible target down here. I do see that, and I can use a strategy builder for that. Send to, give me a strategy builder, it's going to spit out. But again, notice again the dates that they're giving. Dates that come up are for July. That's not necessarily what I want. I want a solution now. So even if I go in a smaller time frame, really, I mean, I'm not seeing anything here but this vacuum, this gap. Yeah. So Joe says, Don't even do it." Yeah. No. I mean, only time that when I should do something like that is if we have a big, violent bar to the downside. Maybe I can make this into red and just kind of draw the imaginary, imaginary line that we are down here. I hate these commercials. I really do. Um, so if you would have like a big red bar come down like this on all of them, on every one of them, all of a sudden you come up and you have this big red bar down, and it's like, okay, now it's a panic. Now you need to pull up your parking brake because your regular brake doesn't work. So in a case like that, you just need to pull up the parking brake because the line in the sand that I talked to you about earlier is being broken. And you're like, let's try to save whatever we have. And that would, at this point, assume that you have a situation in which really you still have a long call, which is a 375, and we are going down. The only question becomes, is there greater than $1.80 value for me to turn it into something worthwhile? Because if I only get the $1.80 for selling this and my long is $1.80, then the trade doesn't make sense because I'm still risking here $100 to get what? Nothing. Oh yes, I completely lost you. I don't know what the heck you're talking about. Okay, let's go over here. Let's now take a look at our current position. Our current position has 0 days left. I pay $1.80 right now. If I would turn this into bear call spread, are you recognizing? I'm getting $1.75. This trade does not make sense. You would now be risking the difference of the two to still end up in a loss. What's the name of the lesson? Good, bad, and ugly. In reality, I can just call this lesson a realistic or objective view of the call. I can call it. I'm sorry, I'm typing so fast that I missed the B. So there it is. Objective view of the call. It's great when the price rips to the south. It could be bad when you turn it in a bull call and this thing rips to all the way 380 and you have cut the leg at 378 and all that you made was that lousy 31 cents. But if you didn't have that 31 cents and we ripped to 380, you would have picked up additional $2 and you would be smiling all the way to the bank. Because if you went to 380 and you have a 375 call, that's $5 of the in the moneyness. And even when you subtract the $1.80, you still made the $3.20. But no, the bad thing is that you sold the 378, you brought in that 31 cents that was bleeding out of you. And why would this thing be bleeding out of you? Because the time value to begin with when you got in was what? Dollar. Because really the pricing of this at the money should have been at what? 80 cents. Well, but I can click on this and predict that we're gonna go. Okay, go ahead, click, and then tell me right here what is the number that is showing up. Target is what? June 30th. This most likely is gonna hit that target if the feds are now accommodating. They're kind of saying, well, maybe next time when we increase the interest rate, it's not going to be 0.75, it's going to be 50. And maybe some of them maybe say, oh, it's going to be only 0.25. Maybe some of them say it won't be any. That would be then construed as a bullish and the price would go up, right? But you have a contract for today, June 21st, and this is aiming that this is going to go up. So just be aware of it. This is a very, very powerful tool. It tells you can do the bull call spread, exactly the one that we talked about. I mean, look, I'm going to actually capture this one. So you would recognize that what I came up with and what is being spit out here, it's the same. It's the same identical trade that we have entertained here earlier together. We have entertained this trade at the 378, 375. So take a look. If I now dump this in, what are the numbers? 375, 378. So it's exactly the same trade we have entertained. The numbers are different because it's picking up the what? July 15th. So either way, be aware of it. What is a long call? It's a bullish outlook. And if you don't get the bullish outlook right then and there, then you have this feeling that you got in the elevator right after the kid came out of the elevator and touched every single button of the floors. And you're going to the floor, I don't know, whatever, 14. And before it goes there, it's going to stop on the second, it's going to stop on the third, and every one of them. You can't afford that with a long call that has a 1 day to expiry. You need the doors to close of the elevator and to shoot up as fast as it can to your floor because you have a bullish outlook. It needs to move now. So definition of the long call is the right to buy, and you lock the strike price at 375. How much higher? Well, that's why you want this elevator to shoot up to the moon if possible. So this 375 gives you the right, or provides you an option, provides you choice to convert this into a contract that can be the ownership, but you would need to then have a $37,500 of cash sitting to do this. In fact, when I was logging in the platform, one of the things got filled here. Like where was it? No, it wasn't in this account. It was in another one on a previous trade. So I ended up having 200 shares, and there was an illegal buying power. I need to exit it out, and I got the sign at 365. Yeah, I got the sign at 365, and this was a 375. So think about it. If this is a $10 higher, how much my profit should be? Hint, hint, hint. This much. This much. I don't get it. How did that happen? Think about it. This is a 365 when I was assigned, and I exited at 375.89. Do you see the $10 difference between 365 and 375? Multiply this by the shares, right? So that's where this 2000 came up, and it's one of the trades that we did either last week or whatever the June session was. That's why this shows this profit, right? So be aware of it, that the long call, you would need to have a cash to convert this, but probably you don't want to convert this anyway. So long call gives you or provides you this right or a choice or options to buy the underlying at that strike price, right? So it's a privilege. So this kind of strategy of the long call should be done when you have a market that is ripping. The one thing that is bad or that it's ugly is that time decay. It's like an ice cube that is melting, and your movement up needs to overcome the time decay. So are you recognizing this 80 cents needs to overcome this dollar of the time value today? So I can't afford to be in an elevator that the kid has been hitting the second floor, third floor, just to light up all these things. I just can't afford to be there. I want this thing to keep on moving up so my delta is increasing, and I'm feeling more and more confident as the delta is approaching what? 90. And what do you usually exit? When it hits 92, then I roll it. And what I mean by roll it, I exit at this point, my 375. And could I buy at that point 380? If we are at the 381.80, how much intrinsically my 380 is worth? $1.80 of the intrinsic value. Hint, hint, hint. That's exactly what I did with my very first call that I ever bought. I bought it at the 32, but I bought a $30 call that was at the money, and I went out a little bit more time. That's why my premium was worth 350. Okay, my premium was worth 350, but the intrinsic value was 2. So be aware of it. if over here we're sitting at the 381.80, my 375 call, my long 375 call at that point is in the money by the $6.80 with delta of 88. Can I afford to hold this for a $1 move down? You shouldn't, because if this thing now drops at 388.80, you just lost $88 of the profit. Do you want that? Would you enjoy that? Would you enjoy that? Aren't you glad that we did not do anything yet? Because as of now, this thing is doing a poor job going lower. If the bears are really that strong, you would see the bigger red bars. This is nothing. This is a lunchtime, ladies and gentlemen. This is just a lunchtime. As long as we do not lose the high of this green bar, there's a high chance that we can rip higher. So one more time, what am I talking about? I'm talking about the high of this green bar, and I'm talking about the high of this green bar. Do not look at the Dow. Dow is not a good measurement because Dow has already lost it, and Dow has only 30 stocks in it. That's it. Only 30 stocks. It's not very impressive. Okay? So the Nasdaq and the S&P are still solid green. In fact, why do you want to go long on Dow when the Dow is what? The lagger. The Nasdaq was up 3%, S&P is up 2%. The Dow, look at this beast is the one that maybe you should consider shorting it. You know. So recap. What do we learn today? What do we learn today? Well, we learned today that this tool that we have to target, okay, strategy builder, target that 365.41 is a very powerful tool because it calculates for us the day when this thing is going to happen. But in order for us to understand the day when this thing is going to happen, we need to understand the intricacy of what the long call is, or what advantages of the bull call are versus disadvantages. And maybe I can make another lesson about just that whole concept, because just be aware of it over here. I call bull call spread neutral to bullish. It would be unfair for me to call equal, because what do you think it happened right here with my delta? If this delta was originally 60, okay, when I sold this delta that was out of the money, and we can revisit that very easily. I just need to bring up the option chain. I just need to make sure that I don't take what they're giving me here, because I'm picking the what? Expiration today. And I'm unchecking this all other information. And then 3 strike price is not enough because I'm looking at the 378. Actually, it is enough. Okay, 378. Delta is what? 15. So think about it. If the delta is 15, what has happened to my 60 cents delta? My 60 cents delta got cut out by 15 and became what? 45. Now again, good, bad, and ugly. If from now on we start ripping, what is it, ladies and gentlemen, that I'm making to the upside move? Is it still 60, or is it only the delta? It's only what? The delta. Because over here, I had a delta of what? 60. And now, due to the lousy 31 cents, I've given up my upside potential. I mean, there's going to be a time that you're going to turn your long call into a bull call, and you're going to hate that 31 cents, especially if the price rips to 380 or 381 or 382. And you're like, oh, those 31 cents, they were not worth, because you destroy your delta. Well, Josip, I could have picked, yeah, that's that whole thing that I can teach you in the futures, that you can simply add a study, insert the option value map, agree with it, right? You would need to pick exactly what you want, because as of now, it's going to display the following month, like, but the bottom line is that if you start using these things, like, you would actually know where the value map is and everything. But doing this for one day just be aware of it. You do not have enough time to turn this thing around, So what's happening right now? Oh, this thing is going down. Well, this is exactly what I was saying to you. Only if we what? Lose this area right here, then you can say, okay, it's time for me to go what? Time for me to go bearish. Right now, as much as you would like this gap to get filled, often these 60 points S&P gaps do not get filled the same day. I would not be surprised if we come down here. Let me just redraw this. If we kind of move down here in this area, and then all of a sudden we rip to the upside. I would not be surprised with that. So once again, there was a lot of materials that were thrown at you today. I would highly suggest, if you like this, give a likes on the YouTube video, and rewatch this multiple times, and keep sending me these emails, with your feedback. I really appreciate it, and I try to arrange it. One of the feedbacks that I got from one of the students was saying, hey, keep your Word document open at the bottom of the screen as you're talking about, so I can still see what the price action is doing. And as you notice it here most of the day, that's exactly what I did. I was talking here and looking what the price action is doing, or what the option chain is. I wouldn't have done that if I didn't get your feedback. So please feel free to contact me. You know exactly where my email is. And last session, there was nothing to post. I really didn't want to post anything because it wasn't one of those trades. It was just more like explanation of the bullish, bearish, and neutral. So feel free to contact me. You know my email, and I wish you all the best, and have a good day. Bye. Stay hedged.